Hi everyone, welcome back to our channel. Today we'll be talking about how to take quick advantage of market downturns. Market downturns can feel scary. News headlines scream about crashing stocks, falling prices, and economic uncertainty. It's just natural to panic when your investments lose value. But history shows that downturns don't last forever. In fact, when they often create opportunities for those who stay calm and act wisely. This video will explain how to spot these opportunities and take quick, smart action when markets dip. Markets go up and down for many reasons. Sometimes it is a big event like a recession or a global crisis. Other times, it's just normal volatility, the everyday swings in prices as investors react to news or trends. No matter the cause, downturns are a normal part of investing. Think of them like seasons. Winter doesn't mean the end of the world. It just means spring will come later. The key is to avoid letting fear drive your decisions. The first step to taking advantage of a downturn is changing how you view it. Instead of seeing falling prices as a threat, see them as a sale. Imagine your favorite stock slashing prices by 30%, and you'd probably stock up. The same logic applies to stocks, real estate, and other assets. When quality investments get cheaper, buying them can pay off when markets recover. This doesn't mean rushing to buy everything. It means staying rational, doing your homework, and looking for value. Remember that cash is king. Having cash during a downturn gives you options. If you set aside emergency savings, you're in a better position to act. Many investors keep a portion of their portfolio in cash for this exact reason. When prices drop, you can use that cash to buy assets at lower prices. The trick is timing. You don't need to catch the exact bottom. Nobody can do that. Instead, focus on buying when prices are significantly lower than their long-term average. Focus on quality. Not every cheap stock is a good deal. Some companies struggle during downturns and never recover. Look for businesses with strong fundamentals, steady revenue, low debt, and a history of surviving tough times. Brands people rely on, like utilities, healthcare, or consumer staples, often hold up better. Tech companies with solid balance sheets and innovative products can also rebound quickly. Avoid speculative bets or companies drawing in debt. Quality matters more than ever when markets are shaky. Dollar cost averaging, a simple strategy. If you're nervous about timing, try dollar cost averaging. This means investing a fixed amount of money at regular intervals like weekly or monthly. For example, if you invest $500 every month, you will buy more shares when prices are low and fewer when they're high. Over time, this lowers your average cost per share. It's a disciplined way to take advantage of dips without stressing over daily market moves. Rebalance your portfolio. Market swings can throw your portfolio off balance. Say you started with 60% stocks and 40% bonds. If stocks drop sharply, you might end up with 50% stocks and 50% bonds. Rebalancing means selling some bonds and buying stocks to get back to your original mix. This forces you to buy low and sell high automatically. It's a simple tactic, but many overlook it during emotional times. Look for dividends. Companies that pay dividends can be a lifeline during downturns. Even if the stock fall, dividends provide steady income. Some firms have a long history of maintaining or raising dividends, which signals financial strength. Reinvesting those dividends, buy more shares at lower prices, compounding your returns over time. Just make sure the company isn't risking its dividend to stay afloat. Check if payouts are sustainable. Avoid the herd mentality. When markets crash, everyone talks about selling. Social media news and even friends might urge you to cut losses, but following the crowd often leads to bad decisions. Selling a panic locks in losses and leaves you on the sidelines when recovery begins. Remember, downturns are temporary, but missing the rebound can hurt you on the long-term gains. Stick to your plan unless your goals or circumstances have changed. Short-term versus long-term thinking. Downturns test your patience. If you're investing for a goal decades away, like retirement, a dip today won't matter much in the long run. But if you need cash soon, like for a house down payment, avoid risky moves. Know your timeline and risk tolerance. Younger investors can afford to ride out volatility, while those nearing retirement might prioritize stability. History is full of market crashes and recoveries. The 2008 financial crisis saw stocks drop nearly 50%, but markets bounced back within a few years. The COVID-19 crash in 2020 was sharp but short-lived. Even the Great Depression eventually led to growth. These examples don't guarantee future results, but they show that resilience pays off. Panic selling often leads to regret, while staying invested builds wealth over time. Keep emotions in check. Fear and greed drive most bad investment decisions. When prices fall, fear whispers, "What if it gets worse?" When they rise, greed says, "Buy more before it's too late." Successful investors tune out the noise. They focus on data and not emotions. If you're feeling overwhelmed, step back, review your strategy, talk to a financial advisor, or just wait a day before making moves. If you like this kind of analysis, I'm starting a newsletter that covers market topics like this. Every week you will get information about the current situation of the stock markets and profitable opportunities. If you're interested, check the link down below and subscribe. Final thoughts. Market downturns are inevitable, but they don't have to derail your goals. By staying calm, keeping cash ready, and focusing on quality, you can turn volatility into opportunity. Remember that investing isn't about avoiding losses. It's about making smart choices over time. The next time markets dip, take a deep breath, look for better gains, stick to your plan, and trust that spring always follows winter. That's it for today. Thank you for your attention. If you like this kind of topics, please subscribe and see you in the next video.